Okay, so I next want to welcome Stephen Hale. He has a very interesting presentation to give us. I think that modern monetary theory is a very interesting way to begin to understand what the possibilities, especially the new policy possibilities are. A very brief introduction. Stephen Hale is an associate professor, currently an economist and lecturer at Torrens University. He is a modern monetary theory economist, and he advocates a voluntary equitable job guarantee, which you'll very probably hear about. And his profile online notes that he's very happy to discuss modern monetary theory and post-Keynesian economics. In any event, we're very, very happy to have him. He's recently published a book, Economics for Sustainable Prosperity. And now I hand you over to Stephen.
Well, thank you very much, Matthew. And that first thing I'd like to say is that Phil and I work together. We're both part of Modern Money Lab and Torrens University, Australia. And we're putting together at the moment, I think, the first set of global online graduate courses in ecological economics and modern monetary theory anywhere in the world. So there is nothing that has been said so far today that I would disagree with. But I'm going to stay within my lane. I'm not going to be bringing, to use perhaps an inappropriate metaphor, coals to Newcastle. Today, I'm not talking about ecological economics. I'm also not going to be doing the standard introduction to MMT talk either. There are, if anyone wants to watch me do that, there are lots of videos where I do that with lots of cartoons on the net. Instead, I've been asked to talk about myths concerning public money or government money and private money too. Of course, neoclassical economics, as we know, is full of myths, ecological myths, myths about human behavior, social myths. It's full of monetary myths too, and that's what I want to focus on. So what I'm going to say is consistent with modern monetary theory, and there's some modern monetary theory in it, but it also reflects the fact that I spent the first half of my adult life training bankers, including central bankers. And what I'm going to try and do, and I'm going to follow a script virtually, really, to try and do this quickly, is to deal with at least some myths, which I think sometimes creep into even things that ecological economists write about the monetary system. So what I'm going to be talking about is obviously simplified because we only have a few minutes at our disposal, but it is going to be descriptive. I'm going to try and stay away from anything which could be described as an opinion, and just tell you how I understand, having spent 35 years talking about it, the way the monetary system works. So the first myth, if I can just clear the screen so I can see the slide myself. I've only got two pictures on the slides, and they both deal with the first myth. The first myth, which we are surrounded with in the narrative we hear all the time, is that federal spending is funded or paid for by the government, either taxing us or borrowing from us or printing money. If they borrow from us, they have to repay that debt in the future, and they can get into difficulties. The government could become insolvent, might have to slash all sorts of public spending programs. If they print money, it's inflationary. That's the narrative that we're surrounded with. It's based on a notion about the monetary system, which the picture on this slide describes quite nicely. PS stands for private sector, FG stands for the federal government, and most people think that the federal government has to raise money by taxing the private sector or borrowing from the private sector. But of course, the private sector has very little money in the first place, so the federal government is bleeding the private sector dry. Or the federal government is borrowing Australian dollars from China, because that's obviously where Australian dollars are manufactured. And the federal government then wastes all this money on entitlements or on one or other form of imaginative ways of engaging in discretionary spending. And of course, the federal government also has the burden of paying interest to people that it's borrowed dollars from in the past and repaying those dollars in the future. This is a complete myth. This represents the federal government as though it's like everybody else, as though it's a currency user that has to find currency, that has to find dollars before it can spend them. Stephanie Kelton, our colleague, has described this myth using the acronym TABS. You have to tax and borrow before you can spend. This is not right. The truth is that federal government really, it's not funded via taxes, borrowing or printing money. It's not really funded at all, because our monetary system and the monetary system of governments in countries with a similar monetary system to ours is correctly described by the cartoon you can see on the screen at the moment. The federal government is not a currency user, it's a currency issuer. It issues the Australian dollar by its fiscal agent, which is the central bank, the Reserve Bank of Australia. Every dollar the federal government ever spends is a new dollar. Printing doesn't come into it. The federal government spends through currency issuance. Prior to the pandemic, they were spending about $1.5 billion every day, and every single dollar they ever spent was a new dollar. Those dollars, of course, end up in private sector bank accounts. So federal spending basically involves the federal government using a keyboard to make deposits into private sector bank accounts. It's all done electronically. This includes interest that the federal government is providing to people who have in the past purchased treasury bonds. But it, of course, mainly includes the sovereign spending, which creates the social and economic infrastructure on which our economy sits. So the government spends dollars into the system. What are federal taxes about them? Well, as Phil just mentioned that towards the end of his presentation, federal taxes are about reducing the spending power of the private sector in order to create room within the productive capacity of the economy for the federal government to spend on public goods and services without exceeding the productive capacity of the economy and causing inflation. The macroeconomic role of our tax system is to create room within the productive capacity of the economy for the federal government to spend without there being so much spending that it would drive the inflation rate up. What about treasury bonds? Well, treasury bonds are basically transferable savings accounts at the RBA. They play an important role in our financial system, which I'll come to in a moment. But the auctioning of treasury bonds by the federal government is a choice. It is not a necessity. They don't fund federal spending any more than federal taxes do. Instead, they offer people in the private sector the option to get a higher rate of interest on the dollars they hold than would have been the case if those dollars had remained within the banking system. What I mean when I say federal government spending isn't funded at all is that it's authorised by appropriation bills passed through Parliament. In other words, when the government passes its budget, that authorises the federal government to engage in spending. But that's all there is to it. We have a system which ensures that the federal government is able to spend dollars which it has been authorised to spend, regardless of whatever number currently sits in the spreadsheet cell, which is the official public account at the RBA. Second myth, government surpluses. And you remember Josh Frydenberg just before the pandemic boasting about the fact that the government was going to return to surplus. And we've had Labour governments as well as coalition governments in the past who have maintained that their almost their most important goal is to push the federal government budget back into surplus and to repay what they regard as the national debt. Second myth, government surpluses promote financial stability. No. Fiscal deficits, government deficits are net deposits of dollars in private sector bank accounts. They provide private debt-free dollars for the private sector and, for that matter, the foreign sector to hold. How is money created in our economy? Well, when it's created in the private sector, it's created by us borrowing it into existence from private banks. So new dollars under those circumstances come with a private debt associated with them, which have to be repaid. When the federal government spends dollars into private bank accounts, well, that's private debt-free dollars. That strengthens private sector balance sheets. That means we have a less fragile monetary system, not a more fragile monetary system. After all, the federal government cannot run out of dollars, cannot become insolvent the way our monetary system is set up. Deficits are a net contribution of dollars to the monetary system from the currency issuer, from the federal government. What do government surpluses do then? Well, when you pay your taxes to the government, and when there is a surplus, we are paying more taxes to the government and the government is spending dollars into the system. All that happens is that those dollars are deleted. They are destroyed. They are thrown into the electronic bonfire, if you like. Surpluses delete dollars from the monetary system. One of two things can happen under these circumstances. You can have a recession because the private sector has fewer dollars, or the private sector can replace those dollars which the government is deleting from the system by going further into debt itself and creating a more fragile monetary system and potentially leading to a financial crisis. Historically, the private sector has, to quote from a famous economist called Wynne Godley, a habitual state of surplus. If we had lots of time and I was showing you lots of charts, I could show you an IMF chart of the average fiscal position of the 40 highest income country governments in the world over the last 30 years. And you'd see that every single year for the last 30 years, those governments have on average run deficits. And the reason for that is that the private sector has wanted and needed to run surpluses. And in order for the private sector to net save, to run surpluses, governments have to be in deficits. The large government deficits of the last couple of years have been associated with high levels of household saving. Where have those dollars come from that households have been saving? They come from the deficit spending that the government has engaged in. The government has spent additional dollars into the system. They have ended up in private sector bank accounts as saving. There is an exception to the fact that government surpluses tend to undermine financial stability, and that is in countries that have big balance of payments surpluses. So in countries like Norway or Singapore, or in recent years, Germany, a government can run a surplus without creating a more fragile financial system. But that's because of all the demand that's coming into the economy as a result of running those balance of payments surpluses. So if you're Norway, with lots of demand, unfortunately, for the fossil fuels which you are exporting, that is injecting financial assets, it's injecting demand into your economy. And under those circumstances, the Norwegian government has needed to run surpluses down the years in order for there not to be too much spending in total in Norway, which would have been inflationary. So that's the second myth. The third myth you often hear people say, the build-up of government debt is a burden on future generations. No, it isn't. It's a supply of private debt-free money to the current generation. When we talk about government debt, it's more meaningful to talk about net debt than gross debt, but let's not worry about that for the moment. The government's debt is simply dollars which the federal government, the currency issuer, has spent into the system and not yet taxed back out of it. That's all that the government's debt is. Since 1982 in Australia, we have had a practice of the government auctioning treasury bonds to approximately match its deficit spending over time. But as I've already said, all that bond issuance does is it offers savers a higher rate of interest on the dollars which they would have been holding anyway as a result of the net spending that the government is engaged in. Bond auctions play a role under normal circumstances. In other words, prior to the breakout of the pandemic and the quantitative easing that we had between March 2020 and the beginning of this year, on interest rate management, because the official interest rate, the so-called cash rate that we've all heard of, is actually an interest rate on overnight interbank loans between our private banks. And in order for the Reserve Bank to hit its target for the cash rate, to be able to control that interest rate, which is not an interest rate at which it lends itself, it's not an interest rate that it pays on any asset itself, it's an interest rate on loans between private banks. It's necessary for the RBA to control the supply of electronic cash, the supply of liquidity to the banking system. And deficit spending, in the absence of bond auctions, floods the banking system with cash, puts downward pressure on the cash rate, and means the RBA basically loses control of the official interest rate. So that has been, down the years, the main function of treasury bond auctions as they've worked over the last 40 years. And indeed, that was explained by the RBA itself in 1982, when the current system was first introduced, when interest rates were being deregulated in Australia. But those bond auctions are not there to fund government spending. That's not their purpose. They provide fund managers with a nice, safe, interest-bearing asset. They help the RBA in the management of the cash rate. There are other less important functions too, but bond auctions are not about the government borrowing money that it needs in order to pay for its spending. Of course, having auctioned treasury bonds, that means those treasury bonds are held in the private sector and by foreign investors as well. And the government does pay interest on them. But those interest payments themselves are also new dollars that the government is spending into the system. They are mildly stimulative as far as spending is concerned. I say mildly stimulative because they are, on the whole, going to savers who tend to save the interest income too, rather than spend it. They have implications for the distribution of income in the country, but they're not in any sense a burden on future generations. When the government deficit spends now, we are not borrowing from future generations in any sense. In fact, that's an absurd concept. The only way we can borrow from future generations is to use up their ecological space. We can't do that financially. A government which only ever sells bonds in the current currency it issues does not have debt in the conventional sense. There is nothing to pay back. Once these bonds have been issued, there's no reason not to leave them in existence in the monetary system. And when they mature, you just roll them over and issue new ones, but you don't have to do that. If you wanted to, you could pay off the national debt tomorrow. All you'd need to do if you wanted to do that is just replace these bonds with electronic cash at the RBA. The debt would be paid off. Fifthly, a myth which I sometimes see people online propagating is the idea that private banks create money and then lend it to the government. anyone can create a form of money by issuing debt tokens. Let's suppose I was a billionaire, widely known to be across the community as a whole, and everybody trusted that any IOU that I ever issued could be presented to me on demand, and I would always, with no risk, be in a position to convert that IOU into government money, into Australian dollars. In that case, my IOUs might be accepted generally as a medium of exchange in the community, and people might go around spending my IOUs in the shop, in shops. In which case, my IOUs would effectively be money. They'd be being used as a generally accepted medium of exchange in the community. Our deposits with our private banks or credit unions are IOUs, which our private banks or credit unions have issued to us. The deposits we have with our banks are not assets for our banks, they're financial liabilities for our banks. Our banks have accepted a commitment to make good on those deposits. Well, if we go to our banks and we ask for physical currency, they'll give us physical currency. Otherwise they will use their reserves, their exchange settlement account reserves, which they hold at the RBA, the electronic government money that the banks hold at the RBA to pay our bills for us, including paying our tax liabilities to the government. Should we participate in the primary market issuance of treasury bonds? You need to be very rich to do that, but should we be doing that via our banks? Then our banks would be certainly debiting our accounts with them, but in order for us to purchase those bonds, our banks would have to use their electronic balances at the RBA to buy the treasury bonds on our behalf. We regard bank deposit liabilities as money, absolutely. In part, due to the access that our private banks have to the system of interbank payments using exchange settlement reserve balances at the RBA, and also in part, and I didn't mention this a moment ago, due to the fact that the federal government guarantees deposit liabilities of our banks and credit unions up to $250,000. So should our bank become insolvent, the government will ensure we get our money back from them. But we can only buy newly issued treasury bonds via our bank's exchange settlement account funds. Our bank's exchange settlement account funds are government money. Exchange settlement account balances can only be created as a result either of those dollars being spent into existence by the federal government or then being lent into existence by the RBA, by the government's central bank. They cannot be created by private banks themselves. Government debt can only be purchased in the primary market using exchange settlement reserves, which the private banks cannot and do not create. They create deposits for us. When they lend to us, those deposits are IOUs that our banks have issued. To make good on those IOUs, our banks need to use their exchange settlement reserves. Our banks do not create exchange settlement reserves. They are spent into existence by the government or lent into existence by the RBA. So it is a myth to say that private banks create money and then lend it to the government. That is not the way the system works. A fifth myth, which you often see people say we have a fractional reserve system. There is a banking multiplier. For every dollar of cash which is deposited in the banking system, the banks can create $10 of money by creating credit, by lending to people. And this is a problem that we need to do something about. The positive money movement in the UK used to talk along these lines. Well, this is not right. Banks are not required to attract cash deposits before they lend. And indeed, as I was just saying, they create new deposits. They create money every time they lend. They are required to avoid overdrafts on exchange settlement balances at the RBA. And when a bank lends to us, when it gives us a deposit on which we can draw, if we then spend from that deposit, it can lead to an interbank transfer, for example, from ANZ to Westpac, in which case Westpac's exchange settlement account balance will be credited, ANZ's will be debited, ANZ's exchange settlement balance could be depleted. They're not allowed to have an overdraft on it. Under those circumstances, what they normally do is borrow funds overnight from the other banks at the cash rate, or rarely, if they leave it too late in the day to do that, they'll borrow overnight from the RBA itself, but they'll have to pay a punitive interest rate if they do that. But banks do not need cash reserves before they lend. Banks lend first. When they lend, they create an asset for themselves, which is the loan to us, and a liability for themselves, which is our deposit at the bank. If needed, they look for reserves later. And the RBA, in order to keep control of the cash rate, has to make sure that there are always enough reserves in the system for it to hit that interest rate target. And the RBA trades in the bond market every day to ensure that there are sufficient reserves in the system. This has not really been an issue over the last 2 years because quantitative easing has meant there's been a massive amount of excess reserves in the system. I'm really describing here the system as it worked up till March 2020 and presumably as it will eventually work again once we get beyond the pandemic. There is no minimum cash requirement for banks in Australia. There has not been for more than 20 years. We do not have a fractional reserve system. We don't have a banking multiplier. There are prudential regulations, which are the Australian version of the international rules, which major central banks have negotiated and renegotiated a couple of times at the Bank for International Settlements in Basel, in Switzerland, but they are not about limiting the amount of lending. What constrains banks' ability to lend, to create credit, is not the supply of reserves to them. It's the supply of credit-worthy customers prepared to pay them a high enough rate of interest so that the bank can make a profit from engaging in lending. And on top of that, any additional regulations imposed by our banking regulator, which is APRA. But modern banks do not need reserves of currency before they lend. That's not how the banking system works. We don't have a fractional reserve system. The second last myth, compound interest necessitates economic growth. I'm glad to say that there was a paper by, I think it was Tim Jackson and Peter Victor, two very well-known ecological economists, that demonstrated using correct accounting, using what we call stock flow consistent monetary economics, that this is a myth that was published a couple of years ago. But it's still a myth which is widely believed. The mathematics of compounding has frightening implications when correctly applied to rates of GDP growth. So if we say the world economy is growing at 3% per annum, if you could imagine that happening for the next 250 years, of course, that's completely impossible, as we know, but if you were just to do the compounding, you would be predicting a world economy 1,000 times as big as the current global economy, and that's completely insane. But you shouldn't take the math of compounding and the correct frightening implications of applying that to real GDP, and then imagine that that means there being compound interest on debt implies that the economy has to grow in that way forever, because that's not right. Interest payments redistribute income. transfer income from one person to another in society. When you have a debt with a financial institution, the mathematics of compound interest is applied, but in fact, the size of that debt does not grow and grow and grow over time because we make interest payments. Interest is paid by net debtors, it's received by net savers. Maybe the net debtors have to work harder, or maybe they have to increase their output in order to earn the income to make those interest payments. But on the other hand, the net savers have to do less. It's a transfer of income between them. Interest payments are a transfer of income. Interest payments made by the federal government are basically like a welfare payment to savers. In practice, it does not generally compound. And as I said, stock flow consistent simulations of the monetary system, including those done by eminent ecological economists in recent years, have shown that compound interest payments do not imply continuous economic growth. I'm not saying that we should leave the monetary system the way it is at the moment, but compound interest is not the problem when it comes to having a steady state economy. There is no logical need to seek to abolish compound interest calculations on financial transactions to achieve a steady state economy. Seventh myth, the last myth. Increasing interest rates is the best solution to inflation if inflation is picking up at the moment. The truth is the main cause of any inflation dictates its remediation, but there's no simple and reliable link between interest rates and inflation. Rising inflation is a signal of problems in the economy. It's a price signal. Something is the matter if inflation is accelerating. And in the future, if we don't address this issue very rapidly, then of course ecological collapse is going to drive inflation. The recent increase in inflation around the world has been principally driven by the pandemic and global supply chains and our reliance on fossil fuels and rapid increases in fossil fuel prices. It is possible, although this has not been the case in Australia for a very long time, that inflation is a signal of excessive total spending by the private sector and the government, where the private sector and government are competing for scarce resources, and that's driving up prices. But even there's no reliable link from interest rates to spending. First of all, when interest rates go up, that increases business costs and that can push prices up. But secondly, when interest rates increase, although of course that means that people with debts, including mortgage debts, have less disposable income and so may cut back in their own spending, there are other people in the community, including me, who have savings in term deposits who have more to spend. So to an extent that cancels out. And in the long run, higher interest rates can lead to a fiscal stimulus to total spending, because who is the biggest net payer of interest in the country? It's the government. And what does that mean? It means that higher interest rates means that the government is creating more new dollars in order to pay interest on those bonds that it had previously issued. If you push interest rates high enough, you can bring inflation down. But that's generally the result of causing a financial crash, a financial meltdown. Although we want lower property prices, we don't want that to happen as a result of there being a property crash, as happened around the world in 2008. And another major problem here is that higher interest rates in rich countries increase the cost to developing countries of servicing, of making the repayments on the foreign currency denominated debts that those countries have been forced to build up by our global economic system over the last couple of decades. And so the biggest problems from rising US interest rates over the next few months are going to be felt across Africa, across Latin America, across the lower income Asian countries with the US dollar debts. Other approaches to inflation are to be preferred to rising interest rates. Structural, and that can mean something as we can be looking at that in a what's the word? A more surface way, in terms of reducing our dependence on fossil fuels and shifting rapidly towards renewable energy, in which case we're not going to be exposed to the impact of increases in fossil fuel prices in the future. But on a deeper level, it involves looking at the higher purpose of economic activity and everything Phil was talking about in terms of transition to a steady state economy. Regulatory, we shouldn't be using increases in interest rates in order to moderate credit creation by our banking system. Instead, we should be using regulation. We should be limiting the amount of lending that banks are permitted to do. We should be limiting the range of activities that banks are permitted to finance. The regulatory tool is the better way of dealing with the private banking system if you don't want to nationalize the banks than just jacking up interest rates, which don't always discourage lending in any case. And I'm afraid fiscal too. The federal government, as I said right at the beginning, is not going to run out of dollars. Our monetary sovereign government is going to have to use its powers of currency issuance to make the investments that we need to make over the next few years to transition to a steady state economy while there is time. But once that transition has been made, then in a steady state economy, real GDP will not be growing over time. If there are still increases in the price level that we tolerate, then the money value, the nominal value of GDP may be increasing. That may imply that the private sector continues to have a net demand for dollars over time, which will have to be met through the government running a fiscal deficit. But fiscal deficits in a steady state economy will be limited because you'll want a limit to the amount of additional dollars which are being spent into the system once you have set up your steady state economy, once the economy works in a different way, once your aim is not to grow the economy any longer, but to improve the quality of people's lives over time while maintaining and restoring the natural environment and living within our planetary boundaries. If you're going to do that in a way which is not inflationary, then under those circumstances, that of course will place limits on the amount of net spending that the fiscal authority, that the government will undertake. Not because the government is limited in terms of its ability to spend, but because government spending has implications as far as the economy living within our natural environment is concerned. So, a basic truth. What is limited is, sure, what economists call real resources, labor, skills, capital equipment, technology, institutional capacity, all those things are limited. But what is most limited is, of course, our ecological space. Dollars to pay for the investments that we need to make to transition our economy to a steady state economy are not limited. Federal government spending has consequences, but there are no purely financial limits in our monetary system. The money isn't the issue. Our government is a full monetary sovereign. What does that mean? It issues a currency. There will always be a demand for that currency when you have to pay your taxes in that currency. We have a floating exchange rate. Our government is not obliged to exchange our currency for any commodity like gold or any foreign currency which it could run out of. Our government, unlike governments in Turkey or Argentina or Sri Lanka, to take governments which have got into financial difficulties in recent times, has no foreign currency denominated debt and hasn't done for 20 years. We don't have, compared to those countries, a high dependence on imported necessities priced in foreign currency. We can run out of foreign currency. We cannot run out of our own currency. Australia is a monetary sovereign. Our federal government is just a simple fact, faces no purely financial constraints at all once it can pass its budget through Parliament. We face real resource constraints, as I was just saying. The ultimate real constraint is the ecological one. Sustainability requires living within that real constraint, but to get there will require the leadership of monetary sovereign governments using their power as currency issuers to pursue sustainable well-being. And I hope this very quick run through some, not all, but some of the widely believed myths about our monetary system has been useful. But that's it from me.
Thank you, Stephen. What about cryptocurrency? That's a big issue today. How would that impact on the community, consumers and government spending?
Cryptocurrencies are not currencies in the normal sense of the term at all. Currencies in the normal sense of the term are issued by tax collecting authorities. Currencies have the tax system and the legal system behind them. There will always be a demand for the Australian dollar. You have to pay your taxes in Australian dollars. If you don't pay your taxes in Australian dollars, then you end up in difficulties. You can end up in prison. So there is something behind national currencies. There's the tax system, there's the legal system. There is nothing behind cryptocurrencies except trust, nothing else, or except the enthusiasm of crypto enthusiasts. Cryptocurrencies are better thought of as virtual commodities. They are not very frequently used to buy goods and services, but when they are, it's better really to think of what's going on as a barter transaction. What about cryptocurrencies and the government? They don't really have any implications as far as the government is concerned. The blockchain technology behind cryptocurrencies could potentially be used by the government's central bank in the future to introduce virtual currency, but that would still be backed up by the tax system. It wouldn't change anything fundamental. But as I've said, Bitcoin is a speculative asset. I would like to have some Bitcoin if you want to give me some, but then again, I'd like to have maybe a Porsche car, not to drive it around, but I could sell it, I suppose. I can sell Bitcoin to get US dollars, but it's the US dollar that's the currency. It's not Bitcoin that's the currency. It's the US dollar, which is a national currency backed up by a tax system and a legal system. Bitcoin is a speculative asset with more in common with Dutch tulips from a previous generation. I'm not saying they're going to disappear the way the Dutch tulip bubble deflated, but I am saying that the prices of crypto assets are going to continue to be highly volatile over time. Some people will make a lot of dollars for themselves by purchasing cryptocurrencies when the prices are lower and selling them when the prices are higher. Other people will lose a lot, but they are not currency in the normal sense of the term. You will not be paying your taxes to the Australian government using Bitcoin. The Australian government will certainly not start using Bitcoin as a unit of account to assess your tax liabilities.